So I want to talk to you guys about maximizing profit. In this video, we're going to talk about how you can effectively pass prop firms, how you can get out of drawdown, so building on the drawdown recovery video that you guys have gone through, understanding these niche scenarios, what you should do as a trader to absolutely maximize your profit, when you should be looking at manual closing, when you should be looking at particular range plays, which time frames that you can use. So I'm going to show you on the 4 hour and on the 1 hour where I think a lot of traders are sleeping on and not realizing that you're 3 to 4 really good decisions away from getting to six figures and so on. And a lot of traders, they mismanage things. They don't realize that sometimes by getting out of drawdown, you can actually do that with these particular range plays that I'm going to show you on different asset classes. So it's about understanding that, again, your goal is not to make money in the early stages. Your goal is to get bigger amounts of capital. And then once you've got more capital, those months where you finish on 3% for the month or 5%, that can become £28,000. It can become £35,000. You realize you have to have these things in place. I've seen too many traders mismanage positions you wouldn't even believe. They'll let an 8% trade come back to 3%. That shouldn't happen. And there's certain things that you can do by looking at these particular ranges. So now let's get into the technical so you know exactly what you need to do. And this will be the most effective way for you to scale up your funding and so much more. So we're going to kick things off with Euro Aussie. So Euro Aussie will be our first demonstration. This is actually a recent one, this is the V-shape recovery type play. So you can see we have our hook point. You can see price sold off. We come back up. We revisit that area. Now with the V-shapes, we're either looking for two things. We're looking for the insurance entry play, or we're looking for a weighted higher time frame execution. So it's going to be on the 4 hour or on the 1 hour. Ideally, we want to see some wick rejections, not wicking to, wicking through the area of volume. We want that liquidity to be taken out, and then we want to be stepping into that trade. Now you can see this is more of a 1 hour example. So this is post swaps, of course. This is a slightly later in the UK, going into an overnight position. Euro Aussie overnight is absolutely normal. You can see a lot of volume kick in on euro over the Australian dollar. So as you can see, what we've got is a range here. So this is what I'm talking about. What you'll find is that some traders will do something like this. They will put this trade on with good intentions. Let's say you, for argument's sake, you'd done it above the high and it was slightly wider stop. So let's say you just put this on as a 50 pip stop. They'll look and zoom out at the bigger picture. Bearing in mind you're trying to get to higher levels of funding, you might look at this from a higher time frame point of view move and think, well, I want to target down here. And you're not completely wrong with that. What I'm saying is you got to look at your average risk to reward and say, what is the average profit that I make when I do win? Is it 3%? Is it 4%? Is it more than that? A lot of the times you will mismanage a trade, not realizing that you're already running more than what your average profit will be. So it's about understanding that part and thinking about your goal is to get capital. Remember that, not about how can I get the most out of this trade. So if we look at this as a range, and let's say you're either in drawdown, two scenarios, you're either in drawdown or you're in a position where you're going to take your current capital from where you are to six figures. So it could apply to two different scenarios. And what you need to get out of drawdown is, let's say, 3% or 3.5%. And what you need to get to six figures is 3.5%. So what you look at is, well, we've got a range here. And on this one, it's not, and this is a good thing about it, it's not totally the exact target because trading is not exact. But you know you want to be working with 3.5 to 1. I wouldn't ever go lower than 3. I wouldn't ever go lower than 3% because you want that risk reward to be working in your favor and not the odds to be skewed. So what someone will do is they'll mismanage this 3% trade, and then by the time they're out of it, they will end up holding through this, and by the time they've managed the trade, they end up like somewhere like here. And then they'll send in the journal, we'll look at it and go, okay, I understood the intention because you was managing it down here, but you walked away with, let's say, 2. Let's be a little bit more generous and say 2%. What I would say is that it would have been better for you to be out to 3.1 around then, get out of the position and recognize now you're out of drawdown, which is arguably more important from a psychological point of view, technical point of view. And this happens way too often. This is not, oh, we see it here and there. No, we see it every time. We see it all the time, every single month, very regular. So just by fixing this one issue, I'm telling you, you guys are going to get funded a lot quicker and stack up your accounts faster as well. So that's just a simple range play that you can use. Now, if you want to get more at an advanced level, let's say you've got your 4 hour rejection, this is an important distinction. This is not a wick fill because this, as you can see, has wicked through. So we've wicked through here. So even if you took this as a 4 hour play and you was at a more intermediate to advanced level, you'd understand how to crop that through here. And then you can go to the 1 hour when you start looking for minor details like this. You can see the wicks here, so if you want to protect yourself. But as a whole, if we just adjust that back to the 4 hour as a simple 4 hour range play, so this is like a 2-in-1 if you like, 3.8. I would rather you get out at 3.8 versus going, well, if I get to here, let's say you was at, 1% profit, and by banking this trade, this passes your funding. This is where people will go wrong. They'll think, well, if I hold that, I'll get here. What happens? They mismanage the trade. They end up with, let's say, 2 instead of the 3.8 or the 3.5. And then they go from 2 and they just happen to take a trade that was a loss. So now they're back to, not on this trade, but you get the point, they're back to 1%. So they could have got out of drawdown, or they could have got very close towards getting towards funding or to the next stage, but instead they're now at 1. That is a very different place to be, because you will analyze, and this is the key part here, please don't miss this, you will analyze the trade that you mismanaged, and you will likely take some of that energy into the next trade without realizing on an unconscious level. Now the problem is that you're going to live in the fantasy part of, if I would have just managed that trade a little bit better, or if I would have just been a bit more street smart, recognizing that the goal isn't making money now, the goal is for me to actually get towards passing the assessment and get into the next stage, and I'll make money with the bigger account. There are hundreds more that would already be trading 6 figures. So realize how important this bit of information that I'm teaching you is. So that's how you play that. Now, it doesn't have to be just on V shapes. It doesn't have to be just on ranges. But what I have found to be effective to know, like, right, when am I going to just manage something and just hold it versus taking one of these take profit areas when you're stacking your accounts. Arguably, you will get there quicker versus the home run trade. You'll actually get there quicker when you've got these higher time frame range plays just by playing the range. As long as it's over 3%, you're actually good to stack that. And then on the other side, and this is a really niche example, and I'll show you in another one in a second, when you're running profit, let's say it hits 90% of this range within 2 hours, you have to look at, well, what trades have I taken that look like this, that achieve 90% or 80% of the target in an hour or 2 hours? That is where you use your experience to go, this is where our manual close, because you'll still see people trying to beat. This is when you're too professional and too sensible, but without understanding the risks. So let's say they're in a trade and it will be something like they're in here for a 20 pip stop. Let's say the entry's here, it gets here in 2 hours and it's running 6.5%. They try and manage it for the longer term and they end up here getting out with the pullbacks at 3. I'm like, right, you were at 6. You was already, if you close that button, you've passed on your funding, but you tried to be too professional with it. So you got to start looking at these like niche scenarios as well. So this is a simple range play, and this is the kind of mentality I want you to go through when you start stacking that capital. So that is Euro Aussie. Now let's take a look at another simple example that you can use on Euro Sterling. Right, let's take a look at this second example. So we've got Euro Sterling here. You have to understand the difference between when you're playing a range. So for example, if you're playing a larger 4-hour range and you've got massive impulse, this is a much bigger structure, like so, and you're looking for this to play, and you might have higher time frame direction, but it's about risk to reward. So when you're dealing with larger structures like this, you can measure from here to here, have 90% of that range, and then be able to trade that, and then still walk away with 4%, your 5%. But when you're dealing with ranges like this one that I'm going to show you here, you've got this piece of price, so essentially from top to bottom, you're dealing with this range, and you've got to look at, when you're taking a trade in here, is it more likely to stop here or actually commit? We're in a full commitment versus a much larger structure that I just showed you, just like the prior example. So it's about understanding that, because otherwise you'll start looking at trades like this and go, right, if I'm going to take that trade up here with, let's say, a 10 pip stop, I'm going to get out here at 2-1. Like, no, because at that point, it was actually more logical that this would break with momentum and then head towards 90% of this range. And then you're dealing with the 5-1, which is exactly how you should be taking it. So it's really, really important that you don't start then going, well, I'm just going to build it up with, 2%. It's not a good idea. It's 3-1 as an absolute minimum. I'd be focusing more on actually 3.5 and above. But that's very, very important. But this is where you would stack that. If you looked at this from a bigger picture point of view, let's say on the daily, you might go, well, I want to take out that low and I want to look for price to go down to here. And then what happens? You end up mismanaging the trade, and then you end up walking away. Let's say we'll go to a slightly lower time frame. As it starts to break the low, you're still holding that trade and you end up getting out here. So you're in the position, so we'll go back to it. And this is where these small increments really play more of a role than you think. So let's say you were in with a 10 pip stop and you could have got out for, let's say, 5 or 5.8. By the time you're out, because you tried to hold it and be too sensible, you're out of 3.8. And you might think, well, that's still okay. It is okay. There's nothing wrong with that inherently. However, if you're at the lows and you're at 5.5%, and again, that gets you out of drawdown, or that gets you into a position where you're then 1% away from passing on the in-house fund or a third-party fund, don't let greed take over where you're like, but what if it goes to here and then I pass? Sometimes it's better for you to just stack and keep building from there. What you also have to remember in terms of, right, can I afford to take the risk of these trades? When you're dealing with a lot of 4-hour positions, more often than not, the 4-hour position has washed out all of the unconfirmed or the earlier entries in and of itself, which makes it lower in risk by default. Not in every single scenario, but more often than not, the trade is lower in risk because of what the 4-hour has already achieved. So this is another example I want to equip you with. This is going to help you out so much. So this is more of a niche scenario. So we've got Great British Pound over the US dollar. Let's say we're going to take this as a range play. So we've got we'll take it from the wick to here. You can just see roughly the range. Right, so 90% is down here. This would be the play that we're dealing with. You'd have your ray line on here where we've got the 0%, and you're essentially looking for that continuation. If I zoom out so you can see what I'm working with, you've got this low at the bottom of all this consolidation. So naturally, you'd be targeting the low or here. So the fact that this low is very close to all of this range doesn't really give you any reason to hold beyond that just yet, because if it is likely to tap there and wick back really fast, it is. So you trying to trail the stop and hold it isn't going to be effective until we get those larger continuations, which is exactly what we got. Now, forget about the entry further up. Let's look at the first entry here on the 4-hour. So this is how you deal with these niche scenarios. So you've got your 4-hour high test. You're looking to play this range, and you've got your entry on like so. So a lot of you might be wondering or thinking, right, well, how do I know to wait for the 4-hour? A lot of the times you're going to realize that the 1-hour doesn't shape up. It's not about you always waiting for the 4-hour. If there is a continuation lower down, you can still take the trade. But there's going to be a lot of the times the trade doesn't shape up, or it's not confirmed yet, or you've got, again, bullishness, like bullish hanging man's here. And then once you see price wash out, so if I go to the 1-hour time frame and we go back, you'll realize that a lot of the times you didn't have your entries anyway. So by the time that these rejections have taken place, the 4-hour is in. So you didn't really have to do nothing about it. Remember, this is only going to add value to what you're doing. But let's say you're in here and you've got your stop above there, so call it a 22 pip stop. So we go back to the 4-hour and you see you can either do two things here. If you're on more of the basic side of it, you're dealing with 5.7, 5.67. If you understood what I've taught you at a more advanced level, you would go 50% of that wick. So let's actually measure that. So if we go 50% of just the wick itself, so for your stop positioning, yeah, it was pretty much bang on anyway. So you're dealing with roughly a 13 pip stop, and then that changes things. Now you're talking 9.8, but you're still protected in the right area, because at this point, this wick has not only wicked through all of this, it's actually wicked above this tiny little hook point, and that high is above that low as well. So it's wicked through all of it. So if any reason to go above doesn't really make sense at this point. But what you do have is price get to at peak 7%. This is a prime niche example where you might not have seen it to the wick, right? But you could have seen it at like 6%. That's where you go, well, we've got here relatively quick. We've not hit 90% of it, but how much of the range have we actually hit? We have hit at that point over 50, so you're talking into like 70% of that range at that point. So we've hit 70% of the range, and then we've started to see the rejections on the lower time frame. Remember, we managed on the 1-hour, so you'd be going to the 1-hour time frame, and then you're starting to see, right, if a usual range like this, and I've got to here for 7, and then you've seen, right, the 1-hour is closed, you know it's a very bullish closer. So as this closed right here, on the 1 hour, if you're managing that trade, if you was trying to manage it all the way to the range, you could be quite lenient and think, well, I'm going to just kind of leave it here at, roughly 4%, give it room to breathe because we might consolidate a little bit further like that and then drop. That's a genuine thought process, and I don't blame you for that completely. But I do if you're trying to stack your accounts, because there's one question you not asked yourself. What's your average risk to reward when you win? So if it's 4% and you're running at 4% already, and you've locked that in, and then you're actually running at 5.5, let's say you see that pull back, and let's say you see it here, so call it and at a 4.9, and you've locked in 4. You're now relying on waiting for this. But this could be the difference of you actually just passing in funding or getting out of drawdown because you've taken a lower end risk trade, because you've got the 4 hour and the double 1 hour rejection within that, which is actually another added little bonus tip there. But this is where I'll see people mismanage it, and they end up with like 3.4, and the next trade just happens to be a loss, so then they're at 2.4, and you see they were so close to getting there, but because they keep mismanaging like 1 or 2 trades, it takes them back like psychologically, because they thought that price was going to hit and they didn't recognize, well, my average risk reward is like 4% when I win, and this is already running at 5.5, so how about I bank it now and then move on? So it's another one of those niche examples that when you're seeing bullish low tests within the continuation and it's not at 90%, so it's not even got to 90% of the range, and it's more just kind of rejecting off of nowhere, that's usually the sign of a sharper pullback, because typically you would see more progressive price action. And bearing in mind, when you're looking at it, you've got, and this is really key, you've got one big heavy body massive candle followed by a low test bullish candle that's not at 90% of the range. Why is that important as a niche? It's important because this is one huge candle followed by a bullish rejection, which shows it's more likely to retrace most of the move. You see the point here. So it's about me explaining these tiny little details that happen in the moment that you don't interpret, and then you end up banking 3% instead of 5.5. And that 5.5 could have been the difference of you literally scaling up in funding. And that's why it's important to stack those wins. Even when you are playing a range, it's these anomaly examples that I want you to use. So I hope that gives you some thought process. And one exercise that you can do already, which I was going to explain at the end, but I'll explain it now really quickly, is you want to go back through a lot of your past trades to then recognize where would you actually be in funding had you not mismanaged a lot of trades. How much capital would you be trading right now? I'll be really curious to know. You can share it in Discord. If you go back through even your past 20 trades, had you not mismanaged them and understood all of the smaller details to pay attention to, or you banked some of these ranges versus trying to hold on and like manage it methodically and hold on for a longer period of time, where would you be in funding? How many funding challenges would you have passed already? That's a key point to look at as well, because when you mismanage something and nothing happens, because listen, if you bank 3% instead of 4.5%, nothing happens. You still bank 3%. But when you start looking at the consequence of, I've made that type of decision 2 times this month or 3 times this month, and that's been a difference of 2% here, 1.8 here, and 2.2 there, and it could be a difference of 6%. Then you look at that discrepancy and go, how much is that 6% worth to me? Where would that put me? And when you realize that 6% is the difference of you now trading $250,000, suddenly these little niche scenarios become absolutely vital for you to scale up and maximize your profit. So that's pound dollar. Now let's look at this last example, a US oil, and on a different asset class. So the same way that you would deal with this on currency is the same way that you would deal with this on an indice, and it's the same way you would deal with it on commodities. So let's look at US oil. We've got this beautiful larger range here from top to bottom, and we're already in a run of continuation. You can see this larger pullback. It makes sense for a follow through for a phase 1, phase 2, phase 3 into that low. Now, what would you do? Would you hold out for the whole trade to the low, or do you recognize the range itself? Well, there's 2 ways, and there's actually a scaling on this as well. So if we just build it out as normal, you've got your hook point, you've got your gap towards the hook point, and then you've got your 4-hour entry. So again, a more weighted time frame entry up here. So after the bearish close, and the good thing about this, again, there's 2 ways. There was the standard way, or I say standard lightly, but the more straightforward way to be able to get in on the 4-hour, and there was actually an advanced way to have a slightly tighter stop. But if we just look at it for right now as a pure 4-hour entry, you'd have been in roughly with about a 50-ish pip stop, and you'd be playing this range for 90% of that, like so, and then 90% would put you at 6.4, so you'd be fine. Now, this is a good example of something that actually went on further, and for you to then go, wow, where if I would have just left that, I would actually been out of here and I would have passed my funding. Listen, yin and yang, there are pros and cons to everything. When you make a decision, not everything is a benefit. So if I decide to then take my profit at 90% of the range, do I then expect every single trade that I take at 90% of the range is always going to pull back, and then I'm just going to have absolute maximized profit every single scenario? No. But by making this decision, is it going to help me scale up quicker over a series of trades? Absolutely. So don't use a cherry-picked example. And I'm using that as an example of one that went on for longer to explain that to you. It's more in banking the run and using your skill set versus holding a trade. So what do I mean by that? Well, this is the simple entry, and this is where I would look at, right, when we've literally, this is another example. Let's say you didn't have the mechanical management and you were just looking at the lows itself. If you see 50% of the move being done in 1 4-hour candle like this, you close it there at 7.3, right? You close that there at maximum profit because of the momentum itself. Because you know, if you've got momentum into a particular low, profit taking, this could reverse, it could retrace 50% of its move. You don't want to be methodical. You want to manual close that scenario because of the range itself. But if we go to the lower time frame, so let's say you've stacked that, and this is a really good clue. If you look at this, you might be put off by that. Remember hierarchy. This would be your clue that, well, there could be a breakout to get long here. Well, that usually happens not when you have high tests like this. So what you'll find is a lot more bullish pressure in these areas when you see something like that consolidating on the lower time frame. But the whole point here of using the 4-hour in these ranges is the hierarchy of the higher time frame will always override the lower time frame noise. So when you see the nature of that, you're not wrong with that. But you also have to prioritize the hierarchy. Why I always say structure first, candle shape secondary. We've got the structure and we have the candle shape. We're then not going to look at the 1 hour and go, well, that looks like that could be bullish. We're going to use the higher time frame to override that, which is exactly what happens. And then when we're in the run of continuation, we go into the lower time frame. So we go to the 15-minute time frame, and notice how we could take an entry in here. So with our entry in here on the 15-minute at this level, you'd be looking for a stop above there. So let's say it's a 40 pip stop. Again, this would be an example of you're not going to bank that right here when it's already in a run of continuation and you're going to take a 2-to-1. That's not how it's going to work. You're going to look at least 90% of that move, or again at the low for 6%. So let's say you got in on the slightly wider stop. So if we go to the 4-hour first, so we go roughly here. So we've got that positioned at the lows, and you got out at, call it 90% of both. So let's get that on. Let's get that to there. So you've got 2 there. So you got your first one at 6.5, and then your second one here at 4.8. So rather than you holding on for the massive trades on the one trade, I want to get you out of this mindset of the one-hit wonder. Just by you taking more of a higher time frame confirmed entry on the 4-hour, you've got that there. You've banked your 6.5%, and you've also added 5%. So you might find that you actually achieved more by learning how to capitalize on the one run in the range in and of itself versus trying to hold these trades for as long as possible. You'll be surprised at how much quicker that you will scale up by learning how to capitalize on these runs. So these are just simple examples on currency pairs, on commodities. You can apply it to indices. You can even apply it to crypto. Crypto is a bit more on the riskier side of things. I would stay clear of that for right now, but it just goes to show you how dynamic the strategy is. So many more of you could scale up on capital. I have seen painful examples where some of you have told me, Mark, I was running 8% and that would have got me $250,000, but I thought I could make a bit more profit. That is painful for us to go through as myself and as a mentor and as a coach and our coaches as well when we see that, because part of you has to be street smart and go, the market isn't absolute, right? We have random outcomes. You don't know when the market's going to be impulsive. You don't know when it's going to be corrective. You just need to know when to be aggressive and when to be conservative. So it's about having that street smartness to go, if I want to stack these accounts, I want to get towards 7 figures, is me making money in the earlier accounts important, or is it more important for me to scale up? So then when I am making 4 or 5%, that's like a £50,000 month. I would argue that's way more important for you guys. So there is an art to it, and the range plays in and of themselves can be so effective when scaling up. So use them wisely. I'm telling you, you're going to scale up so much more efficiently.